Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Yesterday we had Butters. Yesterday had EYT's 2025 Outlook. Today we have me and Dan Nathan and Carter Braxton Worth.
You make it sound like that's disappointing.
Well, for some people it might be.
Carter's exciting, though. I mean,
I know we just saw him.
We're going to get to do some charts. We got a lot to do, guy. We got to get Carter in and out, but let's hit this.
Okay, let's go. December 12th, 1 o'clock, East Coast, market call. Guy Adami, Dan Nathan, soon to be joined by Carter Braxton Worth. Hope everybody's well. Let's take a look at the first slide because Stifel, not Stifle, says a 10 to 15% S&P correction is coming because of what, Dan? Tell me.
Sticky inflation.
What did we say years ago? What were the two words that I was using over and over again?
Pesky and persistent.
Yeah. And then, of course, Citigroup says $6,500 for 2025 because they have no signs of a slowdown. So as they say, that's what – and with that said, Dan, both can be right.
Well, let's be frank with the S&P. Where are we right here, guy? And I know you're Guy, not Frank, but we're just under 6,100. I mean, 6,500. You're not exactly putting your neck out there. You know what I mean? And we just had a great conversation with our main man, David Rosenberg of Rosenberg Research. And, you know, he made a great point. And Butters' work yesterday, Guy, was saying that, and 2 weeks ago, he's saying on average, strategists overestimate earnings and also their price targets by about 7% each year. And so this is one, and Rosie made the point that the consensus S&P estimate at this time last year, what was it? 4,900.
4,900. Yep.
Here we are just above 6,000. So, you know, like they just chased their tails, man, right?
Yeah, and, you know, but with that said, I mean, there have been a lot of people that have been steadfast in that camp, so you got to give them credit. But, you know, as David pointed out, there are a number of things, and we've talked about it, that are absolutely flashing red. And he's quick to also point out, as we are, a lot of those things are not timing tools. But what we have said over and over again is it gives the market less and less room for error. And I absolutely believe that. And, you know, one would like to think that as the market goes higher, some of the things that we've been concerned about sort of magically go away, but none of that stuff has really gone away. And as David also points out, so much of this has been predicated on 2 or 3 standard deviation moves in terms of the multiple on the back of really, you know, nominal at best earnings growth. And, you know, if you're okay paying 22.5 times next year's numbers, you know, and if you think that will continue to ratchet up, well, you know, you probably, you know, his math suggests you have about a 4 or 5% chance of being right.
Yeah. And, you know, again, I mean, his point also, and this is going to drop in the podcast store tomorrow. That would be the On the Tape podcast. We really enjoyed the conversation, but we were talking about how long does this go? Investors are clearly kind of like, you know, spreading out the duration in which they are thinking about these valuations, and they're thinking about, you know, how some of these big themes are going to play themselves out. You know, he was talking about, you know, we're going to have 25% plus gains in the S&P 500 for this year and next, right? And we go back to, you know, that stretch between 95 and 99, and on average, the S&P gained about 28%, the NASDAQ gained about 42% or so. But back to the earnings growth thing, I thought this was really interesting, Guy. So when you look at 1995, we had 11% earnings growth for the S&P 500, 96, 14%, 97, 2.5%, 98, down 5%, despite the index going up a whole heck of a lot, 99, 27, 28% or so. So again, you could take the averages if you want. You can just look at the price performance. We know that, you know, it's a discount mechanism, the S&P 500, but, you know, we kept on going higher, and the EPS growth in the S&P was not that fantastic. Last thing I want to say, Guy, and I want you to comment on this. I think right now, the Mag 7 total market cap at $20 trillion, it's about 40% of the S&P 500's $50 trillion. And I don't think we've ever had that sort of concentration ever before.
No, I think that's right. I mean, it'd be interesting to see what it, you know, I think the Wilshire 4,000, you know, Carter can opine on this. I think that's approaching like $58 trillion or something. Yeah. So you can start to do the math. I mean, it is being dominated by those stocks, regardless of, you know, the broadening out that people want to say. I mean, the reality of the situation is that's what's really firing the cylinders for this engine right now. Daniel.
Yeah, no doubt. Let's bring Carter Braxton Worth in. We know he's got to get out of here. We got a couple things we want to hit with him. CBW.
How are you?
How are you, bud? Hey, really
Good.
quickly, and help me out here before we get to banks versus insurance. This is an interesting call that you made from the spring, and you're going the other way now, and you're going to show some relative. So when we just talked about 20 trillion in market cap, 7 stocks, you have the S&P at 50 trillion, that sort of thing. Help me understand, an S&P that's up nearly 28% and the equal weight S&P that's up 16% or so. What are we seeing here? Tim Seymour on Fast Money last night made a couple really good points about the relative performance of mega cap stocks, but it seems like on a day like yesterday, they were just powering the entire market, and they seem like they're going to be powering them till the last tick in December of 2024.
Yeah, I mean, concentration is a feature of markets. If you look back over the last 50, 55 years, the top 10 stocks on average are about 20% weight. And yet now, of course, top 10 are about 35. So we're more concentrated than normal, even though concentration is normal. There's two ways to interpret it. It's the money goes, or people go, or ideas go to good things and stay away from bad things. Just like, it would be tough to be in the horse and buggy business now, right? Or the fax. Should we start to go in the fax machine selling business? I mean, things change, right? But it both, one could say that's what makes the market so reliable and assured. These are great enterprises with cash, like Apple, with great innovation. They're attracting all the best hires. When these people show up on campuses, people want to go work for them, right? Where you take an aging company like IBM, the IBM booth probably doesn't have as many people coming over. And yet, the risk with concentration is if and as something goes wrong, and life has a way of having that happen, things really go wrong for the market. So it's a balancing act. It's a magic trick, and all magic tricks can end.
You had a prescient note on March 28th, sell insurance, buy banks. And let's go to the first slide, and you'll see the decoupling took place in it started, I guess, in March of 2022, where you saw the bank index sort of fall off cliff. And that makes sense given what was happening. We recall what happened with Silicon Valley Bank last spring. So you get what I'm saying here. There were reasons why. The insurance continued to be lower left, upper right. But your call was not only spot on, but now you're saying it's time to sort of flip the switch again. This is a pretty remarkable, Carter. So let's walk through it.
Yeah. So the thinking was that obviously these things have some sort of correlation, but it's really, of course, we know that the 2022 peak for both of them before the real sell-off in banks, that's the bear market of 2022. The S&P dropped 27%, the NASDAQ dropped 37%, and insurance stocks, think Chubb or Allstate or Geico, they just keep running their businesses and making their money. And so banks go down and go down more than the market. But then the point in the first quarter of this year was that banks were starting to have all the look and feel of bearish to bullish reversals, right? They were bottoming and curing, whereas insurance stocks were getting steep and uncorrected to the point where they were judged to be vulnerable. So a simple pair trade was argued for. And what we've done this morning is to make the case to close that, to harvest that, and actually go the other way. Now, you'll see that banks are way ahead of insurance stocks since the Q1 period. And so we want to be, and here's the reciprocal. Banks have now tripled the performance of insurance stocks since the time of the initial report. So hence harvesting, that's the first thought, if one has engaged in that, but also now fading banks. And actually, I'd be short banks relative to insurers. This is a relative performance chart, or relative strength chart, however you want to characterize. And what it's depicting is banks' relative performance to the S&P as far back as the KBW Bank Index will go. And this is basically an unmitigated disaster. I mean, it peaks in 2004. Here we are, 2024, and we're below the financial crisis low. We might have some other iterations here, but I mean, that's a stunning kind of thing to think about the great names that are in this, from Citi or JP Morgan, but they have not done anything for anyone who's, there's another way to draw the lines. We can put those two together. And so one could say, all right, but couldn't it rally a bit further? And then that's possible. But I think I was hoping to depict here just how bad this area has been. We might have one other chart, which is more of a here and now. Look at or two. This is, and this one could say, okay, but that's compared to the S&P, which has got Apple and Meta and Tesla. But here, even worse, because this is really bad. This is now apples to apples. This is banks' relative performance to the financial sector of which they are a part because of great names like Berkshire or Chubb or Allstate or Progressive insurance names or broker dealers or American Express. Banks are a bad business. Now, let's look at one more chart we might have. That this is a more here and now. So 2-panel, you've got the KBW bank index on the top, and that is, of course, dominated by Citi and Wells Fargo and JP Morgan and US Bancorp and so forth. And it goes up, and its relative performance just goes down and down and down. If you were to look at the industry that has the most bankruptcies over time, it's this 9,000 banks failed in the United States in the 1929 depression. The S&L crisis in the year 1980, I mean, 3,000, they used to have toasters in the window. Guy, you'll remember that, right? Toasters, and they were giving away popcorn makers. It was pathetic, and 3,000 failed. The financial crisis low, of course, Bear Stearns, but other banks, 500. We've had, it's a very risky business lending money and leverage. And over time, we go back to the final, let's go back one more to the relative strength chart and then to the market. I mean, these things are just not good. Now, that doesn't mean you can't make money as a trade, but this is the story. It's not my chart. It's not your chart. It is just the chart. It depicts data, and banks are lousy.
Yeah, no doubt. I'll just say this before we let you go, and I really appreciate it. If you want to pull up the BKX really quickly there, Amanda, we saw that November 6th move. It had a gap. It kept on going. So it opened on the low, closed on the high. This is the BKX. I think it was up nearly 10% or so, and then it consolidated and then made one more move. I mean, at this point, it's down about 4.5% from those highs. So let's see how it acts, because the S&P, and you just mentioned this relative to the S&P, is acting pretty well. It's right near those all-time highs. So, Guy, this is one we're going to keep an eye on. Carter Braxton Worth, we really appreciate you being here. For more of that fine work that he just walked through, go to worthcharting.com. You can get it. It's one of our first reads every morning, isn't it, Guy?
No, 100%. Carter's work. I mean, look, those are timestamp things that he puts out there. We're not cherry picking. I mean, he just happens to be very good at what he does. And, I'm sort of with him on this one. The run into banks made sense at the time, made sense through the duration. But now you're getting to levels that, to me, are not making a lot of sense, especially if yields continue to go higher, which is a different conversation. But, thanks for Carter for joining us. We got to look at Adobe, because we talked about it yesterday. We actually pointed out this pennant formation, Dan, and here we are. You can say we're holding it. You can say we're through it. You can say big. Here we are. I mean, this is a make or break point, I think, for this name. And, I'm not trying to make a big deal out of it, but it is a quarter of a trillion-dollar company, $230 billion or so, that has not traded particularly well now for quite some time. So it's going to be interesting to see how this closes, and then what the trickle-down effect, if any, could be for some of these, I guess, tangential names.
Yeah, it's interesting. We've been talking about what the next leg of this generative AI trade is, right? And so there are some logical sort of extensions. Maybe it's insurance, maybe it's financials, maybe it's some industrial processes, maybe it's biotech. There's a whole host of things that you can envision about this technology and how it's going to basically make, discoveries in certain industries or increase productivity and the like. What it's very disruptive, though, is for a large part of the tech sector, right? If you've established this business model, whether it's a SaaS business model like Adobe and some of these other have, at some point you could say that the incumbents in these spaces that have been renting seats, right? This has been their recurring revenue model. At some point, that generative AI is going to really put a target on their back. Well, that's what's happened to Adobe all year long. And when you start to see, Guy, you and I were saying on Fast Money last night, I mean, that slight miss that we saw and that guide down, we're talking about 1% to 2%, I think, at the midpoint of those guidance. Does that deserve a 13% move to the downside? And the only thing I can think of is just the positioning, or investors looking for opportunities to kind of peel out of stories that are not growing the way that you would justify a 30+ multiple, is what they're doing in a lot of other software names.
Well, I mean, you just hit the nail on the head. I mean, they had to, again, the quarter was fine-ish. I think it actually was fine. The full year guide was not great. And people are saying, well, wait a second, you're obviously coming off a great quarter, and you're being very, I guess, I don't know, conservative with your guide. What do you see that we don't see? And why are you then deserving of the valuation you're trading at? The market saying, well, you're not. And I think that's what's going on here. So we've reached a point in the market where you have to continue to deliver in a meaningful way in order for these valuations to continue to be justified. And quite frankly, I think that's one of the things you're seeing with NVIDIA right now. And I don't want to make a huge deal out of this, but since the day after their earnings release, when it traded up to 152 and change, I think it was 152.89. You're talking about $138 stock now on a broader market that's done nothing but go up over that period of time. I mean, that's something to watch as well. Again, I'm not trying to make this a cataclysmic thing, but the point is the magnitudes need to continue. Otherwise, the market's going to start to sniff you out.
Yeah, and NVIDIA is a great example. I know we talk about it every day, but you look at that sideways action. The S&P is very near its all-time highs. The NASDAQ is also, we know that this has been a fabulous performer, up 175% of the year. It's up a lot more over the last 2 years, but the stalling out is maybe reflective of the idea that the ecosystem in and around generative AI into 2025 has to broaden out. But one of the reasons why we've been highlighting some of the server makers like Dell and Supermicro, some of the memory providers like Micron, today it's Western Digital, which is also a storage name, NAND flash and stuff like that. We'll pull up Western Dig. It's down 5% today, WDC. That's how it comes out here. So if you're going to see, some continued weakness in some of these names here, sooner or later, there's got to be other places that you're going to want to place your bets within technology, in my opinion, as we head into 2025. So maybe that's what that NVIDIA stalling out means. And trust me, Guy, don't trust me. I'm asking you a question. Do you think the way NVIDIA goes is the way that the rest of this trade goes, at least in the short term?
Yeah, I do. But, with that said, if you think about it, when NVIDIA fell off the cliff back in June, the broader market didn't really, if that June move from 130 something down to 90, you would have thought that would have been cataclysmic for the market, given the magnitude of that move. And it really wasn't. But I'll say again, to answer your question, yeah, I do think at this point, given where it is, given the market cap that it now enjoys, I do think it's really important for the broader market. And, I think to a certain extent, a lion's share of this market is still built upon this AI hope trade that NVIDIA sits at the top of. So
yeah,
let's see how it shakes out.
Yeah, I think that there's a lot of headlines that you got to pay attention to. And one of them, we know that Broadcom is reporting after the close 7% implied move. We're going to put this article from Bloomberg in the show notes here, and I'm just going to read the first paragraph. And these are the sorts of headlines you better pay attention to. Apple's ambitions plan to create in-house components for its devices, which include switching to a homegrown chip for Bluetooth and Wi-Fi connections starting next year, a move that will replace some parts currently provided by Broadcom. Okay, so when you start piecing this together, Apple has really tried to kind of vertically integrate on a lot of the components that go into their devices, and we've seen some stocks, trade, very poorly in and around this. You don't have to wait until that happens. If you're looking at a stock like Broadcom, and I'm just going to pull up, what percentage of their sales come from Apple, you can start discounting that out, right, Guy? As you think about what 2025 or you know what I mean, like what it's fiscal year 2025 or whatever it looks like. So thoughts on that a little bit, because I think that's the risk to some of these stories, is that some of the biggest buyers of this tech are going to get away from NVIDIA. They're going to get away from Broadcom, these single source sort of situations.
Well, we're going to find out, aren't we? I mean, there's a lot to be gleaned, I think. I think we learned a lot from Adobe. Obviously, we're going to learn a lot from Broadcom as well, I think. And here's your chart, implied move of 7%. I've been on record as saying, I think we're going to take out those prior highs. If you this is a static chart. If you do a longer term chart, Amanda can throw it up. I mean, we're right up against it here. Valuation, despite the fact that, again, $180 stock, you think, oh, it's expensive. It's not crazy expensive. And you're up against these prior highs that we've seen a few times this year. Logic suggests we'll take it out. However, if we don't, that 150-day moving average of 163 is absolutely in the crosshairs. But it's going to be predicated on I don't think it's predicated on the quarter necessarily as much as it will be the commentary, the same way it was with Adobe.
Yeah, and all those points I agree with. One of the things, though, is that they have tremendous customer concentration, right? So I just mentioned Apple, 17% of their sales, I think. Alphabet's about 8.5%, and then you have Meta at about 6%, Dell at about almost 4.5%. So
Which all makes sense.
yeah, so you just want to be careful. And to your point about taking out those prior highs, it's been in this range. Most of the names, Nvidia, you could say, has been consolidating the last few months, and here we are. We never made a meaningful new high or breakout. Maybe they can pull up Marvell. MRVL. Again, this is a stock that trades well on valuation too. And look at that breakout. That's pretty epic. That goes back a couple of years there. So, beat and raise, you better do it by a lot or you will not be rewarded. And that's one of the things I think a lot of investors are going to pay attention to. What is the magnitude of the beat and raise for Broadcom? And then when did they start factoring in companies like Apple, kind of just trying to, take them out of their supply chain?
No doubt. And I've been looking down because I wanted to see where this 30-year auction came in. So that we just had a 30-year treasury auction, $22.2 billion. Bid to cover was 239, which is actually pretty good. But the yield was expected, I think, of 4.532, and it came in at 4.535. So it's probably a B auction if I had to grade it. Although Rick Santelli does a much better job, as does Peter Bookvar. But with that said, you're seeing 10-year yields now, I want to say, Dan, around 431, which is probably the highest we've seen over the last couple of weeks. I just wanted to get that in there.
By the way, Peter Bookvar of Bleakley Advisors is going to be the On the Tape podcast guy that drops next Friday. I'm always excited to hear from Peter. We got to hit this Costco. So this was last night we were playing that game. What is it?
Trade it or fade it.
Trade it or fade it. Our producers, this is on the Fast Money. They come up with a bunch of names, maybe this event or something like that. And trade it means you're a buyer, you're waving it in, and fade it guy means what?
You're selling that bitch.
You're selling that bitch. So they got to me, that whole list of names. What did I say? I don't know.
You said I'm fading this thing. Very dismissive.
I said I'm fading all. I don't even know what the list. I
fading them all.
Yeah, fade them all. We could talk about valuation here. I think you made a really great point last night. This is kind of not too dissimilar than the Walmart story here, the share that they're taking out of wallets and the like. But, 3% implied move in either direction. So think about that, right? You want to buy an at-the-money put, costs you 1.5%. That, that's a 1 day. That's a binary thing. The same thing for the call. Guy, the stock is not generally a huge mover. Well, it hasn't been over the last few quarters, but 3 quarters ago it was down 7.5%.
Yeah.
4 quarters ago it was up 4.5%. These are after the earnings. So this stock, it can move. It just hasn't over the last couple.
No, again, given the valuation, and I definitely put myself out on a limb, which I'm more than happy to go out on because we've been somewhat steadfast about Costco despite valuation for a while, but it's reached a point now in terms of where it's valued at where they better frickin' deliver in a meaningful way. And it's got to come in the form, obviously, of sales, but margins as well, which I do think they're going to deliver upon. But if they don't, then that 6-7% that you talked about is absolutely in the cards, and it won't be to the upside, unfortunately, be to the downside. So, I like Costco here because I think despite its valuation, it's living in the same world as Walmart. It trades more expensive than Walmart. I don't know if it's necessarily that justified, but it's still one of those names. It's been, despite a couple of downdrafts over the last 6 months or so, pretty great stock to own. So we'll see. But I do think this is it's going to be a bit of a tell as well, without question.
Guy, as long as we've been doing Fast Money, you've been doing it for like 38 years. I've been doing it for, almost, 13, 14 years. When I think about this stock and how many times we've talked about its premium valuation to almost every other retailer, you think of the size of this company, the revenue base of this company, the earnings power of this company, the recurring nature of a small portion of the revenue with the club. We've been talking about this stock but 55 times expected earnings of 9%. I mean, you better love this story. You better love their execution. You better love their positioning. It's just not for me. Now, that being said, that thing consolidated just under, $900 between 870 and 900 for what, 2 or 3 months. And if you had that view then, that was a really nice way to play this thing for basically 875 to 1,000.
Yeah. No. So again, this is an important one. I think, again, it's funny, you early December, I guess, and you have 2 big earnings releases tonight, seemingly, on the odd end of the calendar, but Broadcom obviously is going to tell us a story. And I think Costco, obviously in a much different world, will tell, a much different story about where people are shopping and what does it mean to the overall ecosystem. So it becomes a really interesting day. By the way, we do have some questions. I want to get these in real quick. This is from T-Bug, Dan, and he's directing his ire at Amanda, which I love. Yeah, give Amanda shit. Why not? But he says, my Uber trade is being obliterated. Dan, can you go over the call spread on Uber? I'll tell you, when we first brought up Uber, what we said was, the move was, I think, exaggerated. This is a stock that went from 87 down to about 60 or so. I thought it could trade down to the August low, which I think was 59 on August 2nd-ish. It got close, but I actually think Uber's a little overextended here. And today, at least, it's up, I think, a couple percent on a, somewhat benign tape. So thoughts on that?
Yeah, listen, I was obviously early, right? And you think about the magnitude of the move to the downside from that day after Tesla's robo-taxi day. You saw the stock break out to a new all-time high on huge volume, right? You see that gap lower. There's some competitive stuff as we got into early November. Again, another competitive headline. Waymo is going into Miami. They're not going to be partnered with Uber the way they have been in some of these other markets. And listen, we take this stuff seriously. Hopefully we kind of put out a lot of the analysis, a lot of the inputs that are causing us to kind of put some of these trades on. But, when we do long premium directional trades, and we always give this caveat, okay? When you have a sort of breakdown like we saw below that 150 at about $71, and you see the sort of volume to the downside, sometimes you won't get a chance to kind of cut your losses in a long premium trade, like in a call spread, like we're talking about here, or like we were talking about here. You got to cut your losses. It's just that simple. It's not like waiting around for a stock to kind of get back some of those gains, that sort of thing. And you can average into it a little bit. We don't suggest averaging into losers too much, right? That's kind of a losing strategy generally. But to define your risk using calls or call spreads when you're bullish on something, that means that you are kind of, not that certain about the outcome, but you have set a time period on which that can work, right? And so the idea is, if that call or call spread loses about half its value, you just got to move your feet and you got to look for another opportunity. So that's the way I trade options. That's the way I do them into events, or as far as trading from a sentiment standpoint. And we take it very seriously. So the idea of getting obliterated in something, hopefully you figure out how to give some sort of you're spreading your book out a little bit. You're not putting too many eggs in one basket. So that's the way I think of this trade.
Gary Webb's here every day. Sorry, Gary, I'm just seeing this. He asked Carter what the best ETFs for pair trades are. Save that for the next time Carter's back. I'm sure he will have an answer. Mike B asked us about, can you cover the NVIDIA probable direction? I think we just addressed that, Mike. I hope we did. I'll be crystal clear. I think the probable direction, given what I've seen over the last couple of weeks, is lower. JM460, here's a good one, Dan. I can't opine because I don't know what the vol is on these, but thoughts on buying Jets March $25 puts. So in the money puts, my sense is they're probably expensive. You probably have the options chain in front of you.
Yeah, I do. So what expiration was it, guy?
March 25, March 2025, $25 puts.
Okay, so here we are. It's slightly out of the money. Let me just go to March expiration.
Slightly, right? Oh, it is 25.80. I thought it was lower than that. Okay,
yeah,
there you go.
So if I'm looking at those, and this is how I kind of think about this stuff. Now, the Jets is not an active trader in the options market. So you really want to be careful when you don't have a lot of liquidity and there's a big spread between the bid ask. You do not want to cross that one way or another, right? Because every penny, every nickel that you're looking at in a trade like this makes sense, especially if you're buying just the put, because you're looking out to March. We have about 3 months between now and then. If the stock or the ETF in this case just goes sideways, this is going to just decay, right? And you could actually go into the money at some point, but you could be losing money on the trade. So I look at these 25s, they're offered at about 125 right here. You can do the math, though it's at 5% or so. That's what you need just to kind of, to kind of break even on this trade. If you're paying 125, you have to get this thing down to 23.75, right? Look at that gap that we have there. That's probably 23.50 or something like that, guy. I'm just kind of eyeballing it. We did fill in that gap after some of those airline earnings, and that was just kind of off to the races. So again, I which way I'm directed on this one. I mean, it's just hard to kind of keep picking tops in a game like this.
And you've had a couple analysts along the way. I think somebody doubled their price target, or didn't double their price target. They gave a price target in United that was double where the stock was trading. So a lot of people getting excited there. By the way, T-Bug is coming back and saying, thanks, Amanda. I got into Uber right before earnings, way before Dan went over it. I wasn't meaning to give anyone crap. T-Bug, you the man. No doubt about it. We appreciate
well, if he wants to give crap to somebody, just give it to Amanda. We appreciate it. We get crap all day long.
Nah,
so
don't give it to Amanda. Amanda's the best.
Okay,
what happened to gold? This from the big dog. Well, I think what happened to it was that PPI print this morning, which I think startled some people. That, again, you say what you want. I mean, that was a hot number. And again, it lends credence to those like myself that think the inflation genie is not in the bottle fully. It's still somewhat out of the bottle. And I think what you're seeing is the gold people saying, I don't want to be in front of this. I want to sort of get ahead of it. I want to be ahead of it in terms of what potentially could be happening on the Fed front. I don't think the Fed is going to change their tune next week. I don't think it necessarily matters at this point. I think gold continues to be a trade that's going to have some moves to the downside along the way. We've highlighted that. But I will say again, what I've seen, what I've read, and what I think is going on in the world, all roads continue to lead to gold, Dan. So today's move doesn't startle me. It makes sense. It's unfortunate, but you just got to sort of grin and bear it today.
Yeah, and if we're going to put a trend line up there, you can see the 150-day that acts as kind of a bit of a trend line. But if I kind of attach some dots from the February low and I get to the kind of early or mid-November low, you can see that you're probably looking at like kind of 2605 or something like that, guy, as a level of support, and you're going to want to hold it there. We could have drawn another trend line, that was a bit tighter, and we did draw that, and it broke below it. We talk about that all the time. Yeah, tighten that up a little bit. Just hit those lows. It broke below. It had a few days there, and then it came back. I suspect you think this kind of back and fills a little bit, a bit more of a consolidation, and then as we get into a bit more of a macro market, and we kind of get a sense for what does inflation look like, or what have expectations in 2025, and how the Fed is meant to combat that. So that'll be a kind of interesting setup. Guy, I want to get to crude for a second here. We haven't talked about crude oil in a while here. Thoughts here. We're about 70. We've been kind of discussing this kind of mid to high 70 or 60s range, right? And if you just we pull up this chart, we did have a move today from about 69.20 to about 70.20 in a straight line. I don't know what that was all about, but crude oil, interesting when you think about just how some of these kind of geopolitical hotspots, at least for the time being, have quieted up a little bit. That would be the Middle East. That might be also the Russia-Ukraine thing. And maybe they're just not in the news because there's so much going on here. But that crude consolidation is definitely interesting to me, making a series of lower highs, kind of a series, just muted kind of higher lows. Maybe it's making a little bit of a pennant formation, and maybe they can back it out to a few years too.
Now, look, I mean, if you go, you're right. First of all, since I want to say that high on, what was it, October 4th or 5th, or 7th, when we traded up to 78, you're right. I mean, it's been a series of lower highs. The lows have all been pretty much the same. I mean, we seemingly stop around 67 every single time, or at least 3 times. But with each passing time, the bounces have been lesser and lesser. So it stands to reason at some point that 67 level is going to be breached. I think what's happening here is crude just sort of found a home around this sort of $70 level, and it could potentially just go sideways for the foreseeable future and not be a story in terms of the way it's moving price action. There are reasons to be bullish, there are reasons to be bearish, but I think what the market has figured out is that $70 appears to be the right price. Well, that leads us to C.R. Taylor's question, Dan, about MPC, Marathon Petroleum. And if you pull this one up, I mean, we've talked about this stock a number of times on Fast Money. It was a monster name that has now pulled back considerably over the last, I don't know, since the spring. I want to say it topped out in it. Yeah, I'm right. It made an all-time high in April, and it's been basically trending lower ever since. What I'll say, though, is this. These current levels are the levels that we sort of flattened out around for the majority of 2023, from basically August of 2023 into the new year 2024. That 148, 149 level was resistance on the upside. So past resistance becomes support, and I think that's what we found here. So it's worth watching for sure. It has not traded well. But I do think the energy stocks, again, if you want to just play the valuation game, makes sense, Dan.
Yeah, I think it's important though, as you're trying to get a sense for the health of the economy, the health of the global economy, maybe the inputs to inflation. When you look at some of these oil stocks acting the way they do, and I know you've talked about the large integrateds, and Exxon in particular, has kind of outperformed many of the other names. But I look at a chart like this, and I think that acts like unholy crap. And does that longer term chart look like a bit of a top? And so Exxon, has just came in. Okay, so look at that thing. I mean, like that is like one of the crappiest charts I've ever seen. You know what I mean? Like it held that 150-day guy. That was like a really, really nice orderly, ramp from mid or early 21 all the way to this kind of blow off top. And so when you see a blow off move like that, it's not something you probably want, you know what I mean, to try to buy. And then the other thing I'll just say is, like, we were looking at that crude before, we don't have to go back to it, but that is a very, very long period of bad action right on long-term support too, right? And so that's something to keep an eye on. I wanted to get your take really quickly though, again, in that same theme about trying to get, at least through the lens of the stock market, some sense for economic activity and expectations for growth. Look at this FCX. What do they call it? The copper. What do they call it?
That's Dr. Copper.
Dr. Copper, which I never really like. It's not a term that you use either.
I've never uttered that phrase in my life.
Except right there. But I was asking you the question. Look at that. Okay, it's kind of stuck in the mud over a longer period of time. Let's look at a 1-year chart of this really quickly, though. When I think about this over the course of this year, it's been a lot of time under that, 200-day or 150. This kind of feels like it wants to make a move back towards that double bottom.
August low. Yeah. $40. What is that? Like 39.5?
Yeah. And when you look at this sort of price action, maybe they can pull up letter X. That would be the US Steel. And we know that there's stuff going on there. Nippon Steel was trying to buy them, seemingly blocked. And maybe that was that big move the other day. But these don't act well.
No. Well, and so your point is, what is that saying about not only the U.S. economy, but the global economy? And you're right to point it out. I mean, they're not trading well for a reason, and that's because things are slowing down. There's a reason why the Chinese are throwing, billions of dollars at their markets, at their economy. I think more markets than economy, because of exactly what's going on. And I think our equity market is just not paying attention to that for whatever reason. And, we had that conversation to a certain extent with David Rosenberg. As you mentioned, that drops tomorrow. So I encourage you to listen to it. But, there are a lot of things to be concerned about. And, you're going to say we're cherry picking. We're not. I mean, we're just pointing out some of the things out there that are alarming to us that, the market in aggregate is choosing not to acknowledge right now.
Yeah, really quickly, pull up the DXY. That's a US dollar index, and we know what's going on in a bunch of the other currencies that are kind of tagged against this, and maybe it's the euro, maybe it's some other ones. That consolidation guy, even after such an epic run, like you could go back and look at the summer of 23 into the fall. It looks like about a very similar sort of ramp after a huge decline. So we're kind of stuck in this range a little bit. And you look at the sort of, flag that's being made, not too different than going back to that kind of mid 23 period. And it failed. It broke down, it broke down again. I want to say earlier this year. What would be the conditions for the US dollar to break out? Because it seems like the Trump administration, or at least Trump himself, wants to see a weaker dollar.
I think that's exact. I'm glad you pointed that out, because one would think this incoming administration would be gung-ho about the U.S. dollar. I think they are gung-ho in their want for the dollar to continue to be the reserve currency, which we all want. I don't think they're gung-ho in terms of the strength of the U.S. dollar, because when you have $35 trillion debt, the stronger dollar does not help that. It hurts that. So it's that old thing, Dan. If I owe you $100, I have a problem. If I owe you $1 million, you have a problem. And, so I think that's what's going to happen with the dollar. I think there's a want for the dollar to actually depreciate in this situation, which, by the way, is a hidden tax on the consumer. A lower dollar by definition is inflationary because it makes things more expensive. But the circumstances with which the dollar goes higher right now, I think with each passing day get smaller and smaller. So it's going to be really interesting to see how this whole thing shakes out. I mean, it really is fat. We've never really seen, set of circumstances like this in the aggregate that I can remember. And I go back and try to find things, and nothing really lines up.
Yeah, just, lastly on this, I mean, Trump himself wants to see rates lower. He wants to see the dollar lower. So, and neither one are particularly doing that. So I'm fascinated to see how rates act, yields act towards a cut in the rates. You know what I mean? Next week, and we're going to get that. Last thing, and I'll let you talk about it. We got to look at the Bitcoin, because strong dollar, strong Bitcoin, those don't exactly line up.
No. Well, we had Michael. I encourage people to go back and listen to the podcast with Michael Saylor. It's gotten a tremendous amount of viewership, and we appreciate that. I guess to a certain extent, as long as MicroStrategy is sort of the buyer of last resort, and as long as the market allows them to continue to sort of do these convertible debt deals or sell equity and buy Bitcoin, there's going to be an underlying bid to Bitcoin. I think if for whatever reason the market no longer allows him to do it at the favorable rates that he's getting, then we're having a different conversation. But, when you look at something again, if this were just a stock and you have these standard deviate 2-3 standard deviation moves higher, it's not uncommon to see a back and fill at some point. And I think therein lies the setup for Bitcoin. So is it back to the 150-day moving average, which over time is going to get to about 70,000? I don't think that's unreasonable, because quite frankly, that's where we sort of topped out at for the longest period of time, right? It was 70 to 72, which was resistance all through earlier this year.
Yeah, and this just really quickly, and we'll end on this. When you think about a $2 trillion, asset class that's specifically in the Bitcoin, it's had the sort of move that it's had just in the last month or so. You would expect a back and fill. You would expect a lot of the enthusiasm for the reasons that people have been buying it here. If everybody's on the same side of the boat, and it seems like everybody is, and Trump's been talking a lot about, what is likely to be the policy towards this. Things just don't happen. They can't just wave their magic wand and have this sort of happen. You can't have this reserve, fund that the U.S. government's going to have. It just takes legislation. It's going to have some opposition, that sort of thing. So, again, I mean, you want to buy Bitcoin, you can buy it here, but you better dollar cost average. You better be ready to buy it lower.
It's interesting. And again, just to sort of put a ribbon on that, Michael Saylor did a presentation to Microsoft about Bitcoin and adding Bitcoin to their balance sheet. It was announced, I think, yesterday that Microsoft was passing on that. So just throw that out there, just to throw it out there. So,
well, we saw that 3 years ago. Do you remember? Like, Tesla bought it. He said he was never going to sell it. He sold it. You know what I mean? So again, they tried doing this a while ago. Saylor, he's pretty clear-minded about what he is doing with MicroStrategy, and he'd like to see not only just businesses, governments, and consumers do the same thing.
Yep. So again, I point that out only because, Microsoft passed. It's going to be interesting to see. The conversation is around Bitcoin in the same way that we have a strategic petroleum reserve, have some Bitcoin reserve. I don't understand that. I don't really understand the reasons why, but there's smarter people than I are advocating for it. So we'll see, Dan.
Yeah, I have no problem with it, to be honest with you, because if the Russians are buying Bitcoin, if the North Koreans are buying Bitcoin, when you think about some of these, why wouldn't you want to do that unless you're just helping to inflate a bubble? But again, all right, should we leave it at that, Guy?
I think so. I appreciate the questions, ladies and gents. Check out our podcast with Rosie that drops tomorrow. By the way, if you want to listen to the FactSet webinar we did from Tuesday, there's a recording of that. I thought it was really interesting, 40 minutes. We obviously had the CTO of FactSet. We also had somebody from Perplexity join us, Dmitry Shevelenko. So check that out.
Yeah, that was great. He is the chief business officer over there at Perplexity. We think it's one of the hottest companies in Silicon Valley as it relates to generative AI. So check that out, Guy. We should get out of here. We had a great week. We'll both be on the Fast Money tonight, so tune into that. Check out Rosie tomorrow morning. See you later.